Imagine two investors, one who bought shares at full price and another who used stock options. The market tumbles, and the first investor loses a hefty sum. But the second investor, they only lose what they paid for the options. Welcome to the world of stock options, a place where investors can play the market with a level of protection, where the potential for profit can be great and the risk can be controlled. Let's delve into the tale of two investors to illustrate this point. Meet Investor 1, a traditionalist. They buy shares outright at market price. When the stock price goes up, they make a profit. But when it goes down, their losses can be substantial. They are directly exposed to the market's highs and lows. The risk? High. The reward? Also high, but only if the market plays in their favor. Now, meet Investor 2. They're a bit more strategic. Instead of buying stocks outright, they buy stock options. What does this mean? Essentially, they're purchasing the right, but not the obligation, to buy or sell a specific number of shares at a predetermined price within a certain time frame. They pay a premium for this right, and this premium is the most they can lose no matter how much the market may tumble. Now let's say the market takes a nosedive. Investor 1, who bought shares at full price, takes a hard hit. Their investment value decreases significantly. But Investor 2, they are cushioned. They only lose the premium they paid for the options, not the full value of the shares. So, in a volatile market, stock options can provide a safety net, limiting potential losses. But remember, they're not without their risks. The premium paid could still be lost if the market doesn't move in the direction anticipated. In the end, stock options can be a powerful tool in an investor's arsenal, offering flexibility, risk management, and the potential for profit. But like all financial tools, they require understanding and strategic use. Now, wouldn't you want to be the second investor? So, what exactly are these stock options that saved our second investor from a significant loss? Let's start off by defining what stock options are. They're essentially financial contracts that give the holder the right, but not the obligation, to buy or sell a specific number of shares of a company's stock at a predetermined price. This predetermined price is known as the strike price. Here's the catch though. This right isn't eternal. It has an expiration date, a specific time frame within which you can exercise this right. Now you might be wondering, why would anyone want to buy or sell stocks at a fixed price when the market price might be better? Well, that's the beauty of it. If the market price becomes more favorable than the strike price, you can exercise your right and make a profit. If it doesn't, you simply let the option expire. It's all about opportunities without obligations. Imagine you have an option to buy a share for $50 and the market price soars to $70. You could buy the share at $50 and sell it off at $70, making a neat $20 profit per share. On the other hand, if the market price plummets to $30, you can just let the option expire. No need to buy the share and incur a loss. This is the basic mechanism of a stock option. It's like having a reservation at a fancy restaurant. You have the right to a table, but if you find a better place, you're not obligated to show up. You lose the reservation fee, but you save yourself from a potentially disappointing meal. However, it's not all sunshine and roses. Options come with their own set of risks and complexities, which we will delve into later. For now, just remember that stock options provide flexibility. They enable you to navigate the unpredictable seas of the stock market with a bit more certainty and a lot less commitment. In essence, stock options offer you opportunities without the obligation. Scene script. Stock options come in two flavors: call and put options. Let's dive into the world of call options first. Picture this. You're at a marketplace and you spot a golden apple. You don't have the money to buy it right now, but you're confident its price will skyrocket soon. So you strike a deal with the vendor to buy it at today's price in a month's time. That's essentially what a call option is. It gives you the right, but not the obligation, to buy a stock at a predetermined price, known as the strike price, within a specific time frame. If the market price soars above your strike price within the contract period, you can buy the stock at the lower strike price and reap a tidy profit. Now let's flip the script and talk about put options. Imagine you already own that golden apple, but you fear its price might plummet. To protect yourself, you enter a contract that allows you to sell the apple at today's price in a month's time. This is what a put option allows you to do. It provides the right to sell a stock at a predetermined price within a certain time frame. If the market price drops below the strike price within the contract period, you can sell the stock at the higher strike price, mitigating your losses. The beauty of options lies in their versatility. In a bullish market where prices are expected to rise, investors often use call options to capitalize on potential price increases. In contrast, in a bearish market where prices are anticipated to fall, put options can come in handy to cushion the blow of falling prices. But here's the kicker. You don't necessarily have to own the stock to buy a put option, or need the cash to buy the stock to purchase a call option. You can simply trade the options themselves, making a profit from the changes in their value without ever dealing with the underlying stocks. Knowing when to call and when to put is the key to mastering stock options. You might be wondering, why bother with stock options? Well, let's dive right in. Stock options can be a powerful financial tool, providing unique opportunities for both investors and employees. From an investor's perspective, stock options are used for three main purposes: speculation, hedging, and income generation. Speculation is for those who believe they can predict market movements. These investors use options to bet on the direction in which they think the price of a stock will move. If they're right, they stand to make a substantial profit. If they're wrong, they risk losing their entire investment. Hedging, on the other hand, is like buying insurance. Investors use options to protect their portfolio from unfavorable market movements. It reduces risk by providing the option to buy or sell shares at a set price, regardless of how the market fluctuates. Income generation is another strategy. Some investors sell options to generate income. While this limits potential profit, it provides a steady stream of revenue, which can be particularly attractive in low interest rate environments. Now let's shift our gaze to the corporate world. For companies, stock options are a way to attract, retain, and motivate employees. They're often included in compensation packages, especially for senior executives. Why? Because stock options align the interests of the employees with those of the company. When the company performs well, the value of the options increases. This gives employees a vested interest in the company's success. But it's not just about the money. Stock options can also foster a sense of ownership and commitment among employees. They can feel more connected to the company, knowing that they directly benefit from its success. Remember though, that while stock options offer potential benefits, they are not without risk. The value of an option is tied to the performance of the underlying stock. If the stock doesn't perform well, the options can end up being worthless. So, whether you're an investor looking to speculate, hedge, or generate income, or an employee seeking to align your financial future with your company's success, stock options can be a strategic tool to consider. Stock options can be a win-win for both companies and their employees or investors. Like any powerful tool, stock options can be a double-edged sword. Yes, you heard it right. Stock options, with their potential for high return on investment, can be a lucrative avenue for investors. But with high reward comes high risk. Let's delve into both sides of the sword. On one side, the benefits. Stock options provide a potential for profit that is, quite frankly, unmatched in the financial realm. Here's why. When you buy a stock option, you're not purchasing the stock itself, but the right to buy or sell it. So you're essentially betting on the future price of the stock. If your predictions are accurate, you stand to make a handsome profit. Moreover, options allow you to leverage your investment. Instead of buying 100 shares outright, you can control the same amount of stock with a fraction of the cost through options. This leverage can significantly amplify your profits. But let's flip the sword and look at the other side. The risks. Firstly, stock options have a limited lifespan. They come with an expiration date, and if the stock price doesn't move in the direction you predicted by this date, your option becomes worthless. That's right, you could lose your entire investment. Furthermore, the world of stock options can be complex. Many factors influence an option's price, including the stock's price, the strike price, the time until expiration, and even the volatility of the stock. Understanding these intricacies requires time, knowledge, and patience. Finally, while leverage can amplify profits, it can also magnify losses. If the stock price moves against your prediction, you could lose much more than if you'd simply bought the stock outright. There you have it, the double-edged sword of stock options. High potential for gains on one side, significant risks on the other. Understanding these risks and benefits is crucial to making informed decisions about stock options. So tread carefully, friends. The world of stock options is not for the faint of heart. Let's see how stock options work in the real world. To better grasp the concept, let's consider two practical examples. First, we have Jane, an employee at Startup Inc., a tech company. Jane was offered stock options when she joined, which gave her the right but not the obligation to buy company shares at a fixed price. Fast forward a few years, Startup Inc. goes public and the share price skyrockets. Jane decides to exercise her options and buy shares at the strike price, which is significantly lower than the current market price. She instantly makes a profit by selling those shares. This is a prime example of employee stock options fostering company loyalty and aligning employee interests with the company's success. Now let's shift gears to our second example. Meet John, a seasoned investor. John anticipates that the shares of XYZ Corp will rise in the next 6 months. To leverage his investment, he purchases call options. As predicted, the share price increases. John exercises his options and buys shares at the strike price, which is lower than the market price. He sells these shares for a profit. This scenario illustrates how stock options can be used for speculation and leveraging investments. But remember, not all stories have happy endings. Suppose that instead of rising, the share price of XYZ Corp fell. In this case, John would let his options expire worthless, losing the premium he paid for the options, but no more. This demonstrates the risk inherent in options trading. The potential for loss is real. These stories highlight the potential and the pitfalls of stock options. There's one more player we need to introduce, the tax man. Stock options, while offering great potential for profit, also come with tax considerations that cannot be ignored. When you exercise a stock option, you're essentially conducting a financial transaction, and as with most financial transactions, the tax man is interested. For instance, if you're an employee and you exercise your stock options, you may be subject to ordinary income tax on the difference between the market price and the strike price. On the other hand, if you're an investor and you sell an option for a profit, that profit could be subject to capital gains tax. It's also worth noting that the tax implications can vary based on factors like how long you've held the options and the type of options you have. So, while stock options can be a powerful financial tool, they also come with a tax bill. Remember, when it comes to taxes, it's always a good idea to consult with a professional. Let's quickly recap what we've learned about stock options. We started our journey by understanding that stock options are, in essence, financial contracts. They grant the holder the right, but not the obligation, to buy or sell a specific number of shares of a company's stock at a predetermined price within a specified time frame. We then delved into the two primary types of stock options: call options and put options. While call options give the holder the right to buy shares at the strike price, put options provide the right to sell shares at that price. We explored the mechanics of how stock options work, discussing key concepts such as the strike price, expiration date, intrinsic value versus time value, option exercise, and the idea of vesting for employee stock options. We also discussed why stock options are used, both from the perspective of investors and employees. For investors, stock options can be tools for speculation, hedging, and income generation. For employees, they can serve as compensation, a retention tool, and a way to align interests with company performance. We then delved into the benefits and risks of using stock options. The potential for profit, leveraging, and employee incentives were highlighted as benefits. Meanwhile, limited lifespan, potential for loss, and complexity were identified as risks. We also touched on real-world examples to illustrate how stock options are used in different scenarios, and mentioned the tax implications of stock options. We learned that they could be taxed differently, such as through capital gains or ordinary income. So that's a wrap on our journey through the world of stock options. Remember, while it can be a complex topic, with the right knowledge and guidance, stock options can be a powerful tool in your financial arsenal. Always seek professional financial advice if you're considering using stock options. This video is just a starting point. There's a wealth of knowledge out there waiting for you to discover. So don't stop here. Keep learning, keep growing, and keep investing wisely.